Live.
Looks like we are.
All right. So as everyone's trickling into the event, it would be great as you come in to just type in where you're calling from and maybe the name of your company as well. I'll do a few shout outs.
Yeah, absolutely. This is going to be cool. I mean, you had an amazing amount of registrations for this.
Yeah, something like 180 people.
Whoa.
Yeah.
Whoa.
And I think mostly founders as well. Everyone, like a lot of them tick the I'm a founder box. So
Box. Well, yeah, it's a special kind of community, right? Because being a founder, it's so lonely. Like that journey of starting a business. I mean, first of all, I think you have to have a certain level of crazy going on to think that you could have the audacity to solve problems that people are experiencing and ask them to pay for it. I think that's the first thing. And then the journey of convincing everyone around you that this is a real profession. It is a real job, guys. Like, I think for the first 5 or a couple of years of the business, I remember saying to my folks, no, I run a business. No, but what do you do? No, I run a business. They just couldn't get their heads around, like, you've studied for so long, you've got all this work experience, and now you want to go and start a business? Like, what is that about? Why? And what do we tell our friends when they ask us what our daughter does?
I had that last like a month ago. My mom's like, so what do I explain to my friends when they ask? I'm like, I write.
Exactly. And I mean, there was quite a moment, and oh, hi guys, so cool. Hey, we got some South Africans in the house today. That's going to be amazing. Nice, Sandiswe. So, I had this moment a couple of years ago when we pitched on Shark Tank in one of the businesses that I started, and I was getting ready for work, for the filming, and I'm busy, doing all the makeup and everything, and my youngest child was sitting in the bed watching me, primp while I was doing it, and she said, "Sure, Mom, you're up early." So I said, "Yes, well, I'm an entrepreneur and we have to go to work." And she says, "Yes, I know what an entrepreneur is." And at that stage, I was doing a once a week radio show. And she turned around to me and she says, "It's someone who talks on the radio." And I was like, "Oh, so close. So close."
Like, I respect that confidence. It's like that's what entrepreneurs do. I guess they do talk on radio sometimes if they get big.
Sometimes, yes. Sometimes they get themselves into a lot of trouble.
That's true. And then they're talking on radio.
Yeah, exactly that. Oh, cool.
Awesome. We
Keegan,
have
you're also
a
from
cool turnout.
Wow.
I might plug some people. We have some really cool folks who have tuned in. So I'm going to call out who's here. If you're here and you haven't written what you're up to and where you're calling from, just type it in. It'd be really nice to see where you're viewing from, just in the comments. So we have Collins from Loop Recyclers in Lagos. Awesome. Stella from Nairobi. Smart Regia. Sandiswe, hope I said that okay. Enro Farms.
Sandiswe. Very good. Yeah. We'll
It?
train
Nice.
you so that when you get to Cape Town, you at least have some of that pronunciation under your belt.
Yeah, there's this running joke to everyone tuning in that when I make it to to South Africa, or as an Australian, I have to hide my accent. So I'm trying to get better.
Especially if there's a rugby match that's going on at the same time.
Yeah, that too. Have to be extra safe. Jean from Burner, doing Burner from Kigali. Titus from doing Vua in Kenya. Ashraf from Cape Town. Company is called Pi. Hope I said that okay. Solo from Kampala, Uganda. Keegan from where's that place? Is his way? Hope I said that okay. From South Africa. Go ahead, Lisa.
Oh, we have to work on that.
Yeah.
EC's where, yes, exactly. We're just gonna have to practice.
Okay.
Yeah.
I'll put the reps in.
Get better soon.
Yeah. Cool. Okay.
Ahmed
Aristide
tuning in
from
from
Lome
Dubai.
Togo. Muruthi from okay. who just commented about talking on the radio. William from Accra. We got South Africa. Mona Lisa from Get Funded. Ruth from Accra. And Ahmed from South Africa. Awesome. Shall we?
An expat stint in Dubai.
Yes. Yeah. Respect. That's a long way away. Keen to know the
But
backstory behind that one.
it's yeah, I would too, because it's actually really interesting. A lot of particularly ed tech businesses in South Africa garner their first round of funding in the Middle East. So I wonder if that's the case here. But I'd really like to know the backstory behind Ahmed's journey to get to Dubai. That's very cool.
That's awesome. Ahmed, if you want
Yes.
to chime in, just write a comment. But I think
Yeah.
we're acquainted. I think we've met like quite a few of you guys now, and I think we should dive in.
Perfect.
So let me start with a quick intro of who I am and what we're up to, and then I'd love to get Lisa and Ray's going. So yeah, I'm Caleb. It's really nice to, I guess, for you guys to see me and for me to read your comments. I write a newsletter called Tech Safari, which may be how you found this. And essentially, we're just writing stories about technology in Africa and the founders behind them. And yeah, prior to Tech Safari, I started a company called Entry Level, which was an ed tech. We raised 2.5 million Australian dollars, which is about 1.8 million US. So I've kind of been through the whole fundraising process, have helped quite a few founders go through it, and now as an investor, like really help structure rounds. So that's why, like, when Raise was like, oh, this is like also our jam, it was pretty easy to just be like, let's do a fundraising 101 workshop. And it seems like that's the need because of how many people are here and how many questions we've got. So that's my background. Super stoked to be partnering with Raise for this, and super stoked to have Lisa on board for this. She's she'll introduce herself, but I just wanted to plug Raise. Genuinely love the company, and I think they're doing awesome stuff for founders in Africa. So I'll let Lisa intro herself and kind of take away from here.
Awesome. Thank you, Caleb. That's very cool. And I also love hearing the stories of people that go from like one side of the fence to the other. Where you don't just sit on the venture capital side where you've actually been a founder. I think you're unicorns in this industry. Those magical creatures that we hear of but have never seen. Founders that have actually made that transition, because I think it brings about a certain level of empathy for people that you're working with and that you're investing in, because you've actually seen how hard it really is to build and start a business. So my background is I'm an educator by training. I have a master's in curriculum design, and I did education for a bit, a lot of the commercial subjects, and left education and went into corporate. I then, in a bizarre turn of events, got an expat posting with my family in Lima, Peru. And I lived there for 3 years. So yo hablo español. If you wanted to do a little bit of some practicing of my Spanish, if any of our guests today can speak Spanish, I really need to practice. So did a bit of time there, and then came back and found myself in a position where I needed to start a business out of necessity. And I think in Africa, that is the 80% of the narrative that we find in founders, is that we have to start businesses out of necessity. So as the typical founder journey goes, started a few businesses. Some of them were great ideas, terrible to execute. And within that journey of learning about starting businesses, but if you start a business as a founder, it's a very deep personal journey, because you have to do a lot of introspection, because the majority of the wins or losses in the first, especially those early days, are very much dependent on you. So a lot of introspection into that. And suddenly you realize, like, why on earth are we starting the journey of entrepreneurship and learning about it and I was in my early 30s, at the age where the school fees for those lessons are really expensive. They'll cost you houses, they'll cost you cars, they'll cost you school fees. They're really, really expensive lessons. And so with my background in education and the ability to write curriculums, put together the foundation, which ended up being Future Proof South Africa. And that was the business that I had been running for the past 8 years. I have an amazing team, and an amazing board. And then at the end of beginning of last year, stepped out of operations of that business, handed it over to an operations manager. Yes, to most of the founders here, it is possible to let go of the business that you've started. It doesn't need to be intrinsically linked to your identity. So you can let it go. So stepped out of operations of that, and looked for new problems to solve. And had worked with a very similar business to yours, Edge Growth in South Africa. They have an accelerator called 10X, and I'd worked with them in order to build out their sales and marketing. And the CEO, Marvin of Raise, was in those workshops, and he came to me and he said to me, Lisa, we're trying to raise Africa one startup at a time. And that just spoke to my core values and, my core beliefs. It has a massive transformational purpose, which is how I'm wired. And so I joined Raise to start solving some Raise issues across Africa. And it's been almost a year now, and I actually couldn't believe it when I was reflecting on this. It's been wild, absolutely wild. But going from founder-started businesses where I've done grant raises, I've done angel investment, I've done debt finance, all of the different, into a venture capital-backed business. And with all of that experience under my belt of having to raise and being in a business where there is this type of raise coming in, or funding coming in, and experiencing it really at first hand, what the different flavors of fundraising do to a business and a founder and the team. So that's been my journey thus far. And yeah, other than the founders, I think I'm probably one of the most passionate people about Raise and the problems that it solves across Africa. Because if you just for a moment let yourself, and founders often don't do this because it's very scary, but if you just let yourself for a moment think, what if we can fix the entrepreneurship education and ecosystem in Africa? What if we can raise the level of first-time founders in Africa? What does that do to the entire narrative of Africa and how it grows? I mean, you yourself is moving to Nairobi. I can't wait for you to experience this firsthand, living in this environment of entrepreneurs, necessity entrepreneurs, where the hustle is so real. It's so real. But what if we could do this? And so I love solving big problems, and that's what Raise does, is raising Africa one startup at a time. So to give you a bit of background as to what we do. So basics, cap table management solution that helps pre-seed and seed stage startups organize their businesses for growth. And we make 3 promises. And those are the 3 promises that you can see. We help founders manage their businesses effectively, sell equity responsibly, because often we don't do that. And then we help them hire and retain talent sustainably. And those are the 3 promises that Raise makes in our suite of products and services. Foundational cap table management, but then valuations, equity management, legal services, and a bunch of other products and services that fit around those 3 core promises. And that's Raise. And me, in a nutshell.
The whole shebang. Awesome. Yeah, your story is so cool. And I think the fact that you've just done so many different types of companies before deciding to help other people start companies, it just makes so much sense. And it's also rare, like, just like you said, right? Like having someone with genuine experience being like, okay, I've done this. Let's go try and make this easier for the next, next X number of entrepreneurs. So awesome. I want to go a little bit off topic and just maybe ask a quick question here, is like, because you've seen so many founders and you've seen so many of them and helped them through raising. What do you see the most common, I guess, going into a fundraise or going into like starting a company? What are some of the most common mistakes or gaps that you see the raisers trying to plug in? So I think that will also give some context as to the problem you're solving too.
Yeah. So I think to start off with, the first thing that I often see with founders is that they blur the lines between the problems that they solve and what they want to sell. And so it's Often founders base their businesses on what we call opportunity awareness, and that is something that's coded into entrepreneurs. It's part of their DNA. They can't switch it off. Is this opportunity awareness? They frame every problem as an opportunity, and then they want to go out and solve it. And often what happens with founders is that they lose sight of the problem that they're solving, and they revert to, what do we sell? And so they can't frame it, they can't describe it, and it gets lost in the noise. Competitive advantage gets lost, niching gets lost, all of that stuff gets lost because they've lost sight of, this is the problem that we solve, this is the need that we address. Versus this is the solution, and they always default to the solution. What do we sell? How do we sell it? Because revenue is lifeblood to a business. And so I see that often, instead of focusing on what is the problem that we solve. So that's the first thing that I always see. The second common thing about it is that we build planes in the sky. And that's a very common thing for an entrepreneur, is we say yes, and then we build planes in the sky, that Richard Branson quote that gets thrown around. And the plane in the sky approach is just cobbling something together as you're moving, and often the momentum that you're generating causes this vehicle to be put under severe strain. And so founders focus on the activities that generate the most revenue, just to keep the sustainability of the business going. But at some point, it reaches inflection. And the business needs an injection of capital in whatever form that it needs to happen in order to scale up the growth or increase the pace. But your vehicle that you've created cannot sustain the momentum. It's been cobbled together. It's been shoddily built. And so you haven't focused on the things that will create a sustainable skeleton for growth. And then it starts to crack under the pressure. And you'll see in the discussion that we have, money amplifies. Money is an amplifier. So if you add cash, if you add capital to any situation, it doesn't matter what it is, it's an amplification factor, and it will amplify whatever currently exists. So if you've got amazing scalable skeletons for growth, it'll amplify that. If you have chaos, it will amplify that. If you have culture and value issues in your business, it will amplify that. So I often see founders chasing the money without necessarily having that skeleton, that vehicle that can sustain the momentum intact.
Yeah. That's an incredible quote. Just the idea of money is an amplifier of whatever you have. It just amplifies it. That's such a good takeaway. Awesome. Okay, let's dive into the meat of the session, I guess. Like we want to talk today about kind of like three questions here. So there's three main things we're going to get into. The first is, how do you know if you're ready to raise? Like, how do you decide whether you're ready to raise? Which is the first thing. The second is, what does it look like to kind of have your house in order? And what does it look like to be ready to raise, to get ready to go out there, go to market and get some money in the bank? And then the third one is, how do you actually raise? Like, what does it look like getting momentum? What does it look like really just like pushing through the raise and completing a raise successfully? Which is especially punchy, especially in this market, right? Where we have a lot of founders, you probably know, like trying to raise money, it's rough. It's very hard. And so I think all of these will be super relevant. Let's start with the first one. There was some really cool content that came out. Yes, this one. 10 things to consider when deciding if VC is right for my business. So yeah, take it away, Lisa.
You can see the kind of culture that exists in Raise is that we take what we do seriously. We definitely don't take ourselves seriously. So I've got a little checklist here. I always find checklists helpful. So I've got a little checklist here that I want to talk through with you, and it brings us back to some basics. Am I ready to raise? And I think that's, let's go through these 10 things, and maybe the founders that are with us, guys, if you can give us some feedback, like, have you got 3 out of 10 or 7 out of 10? What's your score like on this? To see kind of where you're sitting, if you think you've got these things nailed. maybe you can give us some insights into what you have got nailed down, how you've got it nailed down, or maybe some questions around those. So maybe give us your score on this checklist out of 10. So the first thing I want to get into is, what is your business? And I think we just discussed this. Your business is not what you sell. That key value proposition, and was one of the things that we worked on when I arrived at Raise, was, guys, let's build your value proposition Bible. And we call it a Bible for a reason, because it is the law book of how we serve our customers. So that value proposition Bible has become the cornerstone to informing everything from services to product to pricing to qualifications of new products and services that we take to market, messaging, everything starts at that value proposition Bible. It's what is your business? It's not what you sell. Does that make sense?
Yeah, love that. I mean, that's the first thing you mentioned as well. I think it totally relevant. I'm trying to see, does anyone have any insights on that, or does anyone feel like they've nailed that or not nailed that part? And can they explain why? Maybe in the comments.
It's often something that happens later on in a founder's journey. Is you need a bit of experience under your belt before you get to, okay, this is the actual value proposition, and it should always be a working document. It should always be a draft, because everything will change. So yeah, guys, if you've nailed that, let us know.
Or maybe, maybe just a question could just be like, if if anyone here knows or can say what their value proposition as a company is, that'd be awesome. It'd be really cool to read those out.
Absolutely. If you can define that, sure, in a sentence or two, that's incredible. Yeah, very cool. Okay, so we'll move on and then we'll come back and see what the comments have been. So how much money do you need? Oh, this is, Caleb, maybe you can speak to this as well as what you've seen. Is that like the heyday of VC funding into Africa, where you could put together a few slides and do a presentation and the money would land in your Mercury account the next day? Those days are over, right? When you're starting to decide on how much money you need, be conservative, because money is an amplifier. And so money, when it comes into the business, is not just going to amplify growth, it's going to amplify pressure as well. So the eyes will be on you. So be conservative with how much money you need and itemize it. I think that's really important. Is if an investor, be it grant, be it seed, be it angel, anything, if you can actually itemize down what you want to use money for, it gives a whole lot more credibility to whatever you're aiming after in terms of raising. It also will help you define who you want to go after in terms of the perfect type of investor for you. So yeah. I love this. Oh, look at the comments. There's some nice comments coming through.
Oh, nice. So we've got MaliPay connects people through mobile payments. Cool.
QE Vault, a technology company that helps merchants accept bank transfers securely and swiftly from customers. How nice is that? Because Raphael's defined that there are two problems that his customers experience. They experience a security issue and they experience a time issue or a time pressure. And so the value proposition statement is beautiful because it actually combines those two things very succinctly. So that's lovely. Very nice, Raphael. I really like that. Yeah, you wanted to ask a question, sorry.
I did. So I guess on number 2, how much money do you need? What's a sort of like, do you have a benchmark or an idea of how long you think founders should have money in the bank for, or what sort of runway measure? I mean, I do, but I'm curious to know how you think about it.
Pre-COVID, I would have said 6 months, right?
Right.
Minimum 6 months.
Yeah.
I, as a founder, have a financial model that has a little red block on it that was built by the most amazing CFO. And it sits there. And as the expenses are tracked, as the income is tracked, that little red block is my D-Day block. Okay?
Yeah.
And it moves. It goes backwards and forwards on months to see when that, and I, as a founder, pre-COVID, I would have had 6 months in the bank, minimum. A year for me would have been great. And that's nice at current burn rate. And then past COVID, yeah, I would say like 2 years. That's just based on what's happened.
Okay,
right?
yeah.
Where I was in education and schools shut down for 2 years.
Right.
We went through 18 months of a business with almost zero revenue coming into the business. And it was only because we had a buffer of cash flow that we managed to survive. And there's a beautiful analogy, and I love analogies, but it's a beautiful analogy that season in business is like a boxing match. We all went 10 rounds. So nobody was pretty by the end of it. Nobody looked good by the end of it. The only winners were the people still standing. And the only way that business survived was because there was a cash flow buffer in the bank account. And so now I'm even more conservative with a runway of saying 6 months at a minimum, 2 years, aim for that as cash flow in the bank.
Interesting. That's fascinating.
And don't start your raise. If you're going after capital, don't start your raise with anything less than 6 months in the bank.
That's the advice really interesting on the pre-COVID and post-COVID experience. I've only ever run a company like during COVID, so or a venture-backed one. So and in that case, I think it was a bull market then anyway. So I feel like there was money lying around. But
bull market from investors, but from a market demand side, it's bearish. So you've got two conflicting almost economic stances.
Exactly.
Hectic.
It was hectic. I think the principle we had was always, and that I always tell my founders, is like exactly that. If you have less than 6 months runway, you lose leverage if you go to raise money, because you're on the edge, and so you always want at least that. But I'd say a good benchmark is 2 years, like you said. 2 years runway is amazing.
Did you read my cheat notes?
What do you mean? Is that your
No, like, did you read my note? Like, we live on opposite sides of the world. We exist in two different economies. So it's amazing to see that there's that synchronicity between we should have a minimum 6 months and a maximum, an average of 2 years. That's very cool.
2 years. I think it's just being frugal and doing it, and knowing how long you need to do it.
Absolutely. And also, I think what you said was really interesting about that. As soon as you hit that 6 month, I've seen it with founders, as soon as they hit that 6 month lead time into the D-Day, that red block that sits on their spreadsheets, they start to make decisions out of fear. And that decision-making capacity gets clouded by survival mentality. And they stop making clear, rational decisions about the type of money they take, where they take it from, and the terms and conditions that are attached to that money.
Yeah. Totally. I think that leads to the next one really well, actually. What are the terms of the deal? Can you jump into that one?
Yes, sure. Read the fine print. Speaking back to the 6 month rule, is that when you're in survival mode, you tend to gloss over the fine print and you tend to absorb more risk than what you would normally tolerate. So what are the terms of the deal? I have an amazing co-founder in Futureproof who said to me right at the beginning when we were putting together Futureproof and we were structuring the organization, and he said to me at the beginning, how does this end? Right? How does this end? And we don't typically at the beginning of any kind of deal think about, how does this end? What do I want out of it? Is this something that is intrinsically linked to my identity? So I'm going to feel personally offended if I'm ousted as the majority shareholder or as the CEO, if there's a takeover, if my board decides I'm not the right person for the job. Like, how does this end? And have that very, very clearly defined for yourself, so that when the terms of a deal come along, you know what the exit strategy is going to be. You know when shares are going to vest. You know if there's going to be a staged approach, as in safes, so that you've got a risk-tolerant approach to equity sale. And so have those things in mind. And if you don't know, go ask. I think founders, one of the things that founders have in their DNA, apart from opportunity awareness, is this thing called self-efficacy, but they really do believe that they are superheroes. So, and that's kind of what gets them past most hurdles. But it's also one of the tripping points of founders too, is because you believe you're a superhero that you can overcome any of the terms of the deal that are there, no matter how daunting they are. Or you'll just absorb the risk as you go. Go and get help to understand what are the terms underneath this. What do these things actually mean at a granular level? And more importantly, go hear it from someone who's done it, who's entered into terms of a deal that look like this. Go find someone and get their firsthand experience of it, rather than, oh, well, I'll just absorb the risk of this deal and I'll figure it out as I go, because the lump sum number that sits at the top there is what I need to survive.
Yeah, that's awesome. So good. And maybe just to add to that, like one of the things that really helped us when we were doing our seed round, we had 2-3 friends who were founders who had done either seed or Series A rounds, who we could just share the like our safes with, or the deal terms with. That really helped. It gave us insight into things that we didn't know before that. So.
No, completely. Sola's got a question here. She says, does it depend on whether you are in a startup phase as to how much money you need? Absolutely does. Absolutely does. Again, the conservatism around how much money you need should be based on stage. And that's why a line item breakdown of what you need money for and how it will be spent will then give you, as the founder, an understanding of how much money do I actually need, build into it CPIX, build into it a buffer, of cash flow. But to do a moonshot raise means that you're accountable for that money. It amplifies the spotlight on you. So if you're in a pre-seed round and you're shooting for a 10 million raise, understand what is that 10 million going to be? How are you going to be held to account for that 10 million?
Yeah, that's awesome. Nice. Cool. Lisa, do you want to keep going with the...
Keep going. The 10 points. How much equity are you willing to give up? Okay. Do your scenarios. That's always my advice. Make sure you've got your scenarios in place, your scenario models in place. If you don't know how to do one, let us know and we'll help you. Because you should have a very conservative approach, you should have a baseline approach, and you should have a moonshot. And so you should have those 3 at least in order to understand what is the effect of money going to be on my business, and then what is it going to be in terms of return as well. So have your scenarios laid out. We also, include things like employee stock options. At what point can you start offering employee stock options to hire and retain amazing talent? And that can also be built into your scenarios as well. So
Lisa, do you have a template for that? Is that like how do you do that? Not how do you do that, but do you have any like resources that can help people with that side?
Yes, absolutely. I have valuations analysts, legal people, lawyers, that we all work together as a team, and we actually build out those scenarios for our customers.
Awesome.
So they know what's coming their way potentially, and they can make better decisions based on actual numbers. In fact, there's a beautiful quote, and I think it's by Peter Drucker, and it says, God has an opinion. For the rest of you, bring data. And that's like, don't give me your opinion on your scenario. Don't give me an opinion on your valuation. Bring the data.
Yeah. That's awesome.
How much equity are you willing to give up? Make sure you've got your scenario sitting in front of you with the data within which you can make best decisions on that.
That's awesome.
Do you have a solid business plan? Okay. And a track record? Okay, guys, a plan is great. Execution is better. So have a business plan that you can actually execute upon, that has a track record of execution behind it. I am from the school of bootstrapping, and I will say that very gently, but I am from the school of bootstrapping, which means I paid my own school fees in the early stages of my business. And trust me, I will never pay those school fees again. When you're paying with OTP or sorry, OTM, other people's money, when you're paying with other people's money, those school fees, I don't know, are just not quite as sticky as they often should be. So having a solid business plan and a track record of execution behind it gives me the confidence to know that the money that is being given to me and put into my custodianship in order to grow this business to this level, I actually have the expertise behind me and experience behind me in order to do what I say I'm going to do. So have that solid plan with numbers and metrics behind it. And then that leads on to the next point: is your team ready? Because money amplifies chaos. So typical founder thing, we've hired the cheapest talent that we can get to do as many things. So we hire Swiss Army knives at the beginning of our businesses, people that can do a lot of things at relative level of quality. But as soon as your business starts to generate income, a decent amount of income, or you're going after a raise, a fundraising round, you're going to need a team that can execute at a very high level and at pace. So is your team ready? Do you have a recruitment plan in place if you're going to be hiring new talent through that? Because if you've got chaos, if your values, if your culture in your business is cannibalistic, it will amplify that completely. Your team will eat themselves alive. Don't amplify chaos.
Yeah. It's great advice.
It does sound a bit like an episode of Survivor in here, doesn't it?
Yeah, I'm like, damn, this is hectic. This could be a TV show.
Well, I've closed a business because of this, and I'll share the story with you quite transparently. I had a business where I had three other partners in the business, and myself, I was the CEO. And we had a massive grant deal that was on the table, but we hadn't figured out our culture. We hadn't figured out our way of work. We hadn't figured out how we will work with one another. And as soon as money landed on the table, it just amplified that, and the team just started eating each other alive. Like, the nasty stuff in people, comes out when there aren't rails and boundaries with which to operate. So I walked in, I was having a horrific time. I walked in at our next board meeting, not knowing where my next salary was going to come from, a single mom, 2 kids, it was chaos, and walked in and closed the company. Because I was like, I'm not signing off on millions of grant funding into this business in order for me to be held liable to execute on the plan that I've presented with a team that is going to focus so much on the cultural issues between themselves rather than actually getting it right, serving our customers' needs. So Oba King, you're absolutely right. Once again, money amplified the cultural chaos that was there.
Yeah, that's awesome story. Wow.
Real school fees, serious PTSD. Yeah. And that's why, like I'm saying in the next point, do you have other options? What have you considered all of your options? Because I think this gold standard of VC capital that's been put on a pedestal, and I'm speaking to someone in VC, so I'm sorry, Caleb, if this offends you, but VC is the gold standard of funding in Africa. There are other options. Have you considered the other options? And underneath that, have you considered what type of investor you have lined up, or that you want lined up? I always say to people, when you're looking for investment, make sure that you've got your checklist. Make sure you've got your hard boundaries in place. Those people, those women that go onto dating apps and they're like, and he must be 6 foot, he must be over 6 foot, he must be dark, he must, and they've got their list, right?
Yeah.
You should have that hard list of things, of the types of investor that you are looking for, and then don't compromise on those things. Doesn't matter what money number gets thrown at you, like, have those lists of your ideal investor. And it could be grant, it could be angel investment, it could be debt financing, it could be anything, and just have that list, and then you'll know whether it's a fit or not.
Totally. And maybe something to add here is like at least in the US, the VC startup relationship, if neither of them fail, like if the startup doesn't fail or the VC
Yeah,
doesn't fail,
yes, it doesn't
actually
fail.
lasts
Yeah.
longer than most marriages. Like it's actually, it's kind of like the same, you know, it's about like
Yes.
10, 12 years. And honestly, yeah.
Yes.
And it's kind of the same because you can't like really
Totally.
get a VC off your cap table. It's extremely hard to do.
No, you
So
cannot.
making that decision, you really want to know you're aligned and you have the right people on
Absolutely.
make or
Absolutely. And I have an ex-husband, so I know what it's like.
Yeah.
Because as a VC and a founder, you guys have birthed something. You've birthed this entity. It's now
Mm,
something new. It's like having children with somebody. You're never going to ever just get over, like, accept the fact that it's not going to end. So
mm,
make sure that the marriage that you're getting into is the right one specifically for your business and the way you want it to grow. So have identified, how do you want this to end?
mm.
And what does that look
So,
like? And that falls into, what are the risks? Point number 8. What are the risks? You don't know what you don't know. I love that saying, because you don't know what sits out there. You've never experienced it. Especially first-time founders. You've never done this before. Now you're taking a whole lot of money to pay for you to figure out what you don't know. So to do it in a staged approach. I think Godson's he's got a question for us, and he says, what metrics do VCs require to invest at pre-seed stage companies? I'm currently pre-seed and want to raise an angel round. Generally, an angel round is sort of pre-seed. So if you want to do a pre-seed business raise, it depends on the VC, really. But I think gone are the days where, you know, people are going to fund something that doesn't really have product market fit.
yeah.
So at pre-seed stage, I think you're going to need to show a level of product market fit that indicates that there is a place for the solutions that you provide to the problems that you're solving in the market.
Maybe I can chime in here.
I
I
think you
just consider
should.
like angel is, you know, you're just asking your friends and family and kind of begging them to give you money to get started. So angel's like
Yes,
before pre-seed, you're not really pitching with that. It's
that's right.
people you know usually. And then a pre-seed, yeah, exactly. I think product market fit is the best way to put it.
Yeah.
It depends on the VC what they want, but I think in this
Mm.
market it is kind of important to have revenue or something that points to revenue. So something that's like, okay, this is how we will make money. This is not just you know, you're funding me and I'm going to go get it. I think maybe a year ago or 2 years ago was different. You could raise off an idea or like
Off an
off your
idea.
experience. Yeah.
Yeah.
But today
Yeah.
you really need something, like you need some sort of
Yeah.
traction or
You
some
need to
sort of,
prove that people are willing to pay,
yeah.
and what price point they're willing to pay. Because if they're willing to pay less than what it costs you to deliver the product or the service, you have a charity. You don't have a business.
Mm.
And we need to get our heads around that. So go and prove that. So if you validated, Godson said he's already validated product market fit, and if you can show traction in that, then you've got a pretty good chance of a VC pre-seed round, depending on the investor and what they want. But I've actually got a checklist a little bit later on, checklist 2, that will give you some of the things that you would need in order to go after VC funding, some of the itemized actual assets that you will need. So we can get to that quickly.
What are some, just quickly,
yeah.
like what are some of the risks to look out for? Like what would you categorize as that?
Okay, so there's 2 things. If you're taking VC funding, you're going to swap 2 things. You're going to swap liquidity with flexibility.
Yeah.
Okay, so you're going to get liquidity, but you're going to lose flexibility. So know what your affordable loss is on flexibility. Affordable loss, what are you willing to tolerate on flexibility? So is it board? Is it decision making? Is it reporting? What are some of the risks around that? And potentially, what's some of the autonomy that you are prepared to lose? Because essentially, if you are not the majority shareholder in your business anymore, you might be voted to be incompetent and taken out of your position. So you swapping liquidity for flexibility. How much liquidity for how much flexibility? And that's always the risk at a high level.
Yeah, awesome. Nice. Thanks for that.
Oh,
Cool.
pleasure.
Maybe
And
we can
that's
choose.
the next point as well.
Yeah. Perfect, yeah. Yeah. True.
Yeah. So legitimacy, flexibility, legitimacy, that's one of the upsides of having VC funding, is if someone's believed in you enough to put money in, it legitimizes your business in the eyes of the market. That can be something else that that is an upside to taking this kind of funding. But it also doesn't necessarily sit with venture capital. Grant funding also has a level of legitimacy to it because of the due diligence process. So there is legitimacy that comes with going through any kind of due diligence for any kind of funding.
Yeah, true. Awesome. And number 10, your gut.
Your gut. I've covered this in the previous points below, is that just you need to trust your gut sometimes. Is that everything might line up, but there's something inside of you that's going, this is not quite right. It's just ensure that you've got your values aligned. You know what you're prepared to compromise on and what you're not prepared to compromise on. And you've got those in stone. And then don't compromise those. Because I can guarantee you that someone who's investing into your business is not going to compromise on theirs. So make sure that there is a good marriage going on.
Yeah, I like that analogy. It's a good one. Awesome. So good. Okay, so I guess now that we've gone through the things to think about as you're deciding to raise VC, let's chat about what does a house in order mean? Lisa, I'm thinking maybe we can jet through these.
Yes,
and do
we're gonna have to do it really quickly.
Heaps of resources on this
yeah,
online as
yeah,
well.
we do.
So, yeah,
absolutely. So I was just going to run through these very, very quickly. This is particularly what your business might look like when you're going into a round. So Godson, this is specifically, you'll find this really interesting. Everything's everywhere. It's all over the place. And you go, it'll work for now. Until such time as you get the pressure of OTM, other people's money. So the first thing, if you're going into a raise, a fundraising round, pre-money valuation. Okay, it gives you accountability. It gives an understanding of the business. It can help you measure progress against goals, and it gives you that better understanding to make better decisions. So pre-money valuation is, for me, an absolute essential. Then the other things, clean up your financing, put all of your equity and your cap table data and your latest transactions into one place. Make sure you have your cap table updated. Mostly for any VC round, you need a cap table in place. Generate a corporate health score. So just know where the health of your business and the equity of your business is. Shareholding, structuring, where are you registered? Is everything in place? Is your tax clearance up to date? And then just pool it all into one place, so that you don't have it some sitting in Google Sheets, some sitting, on the founder's hard drive, it's all over the place. Just pool it all into one place, so that it's easily accessible for yourself and for your investors, or your potential investors that you're pitching to. Your pitch deck should be, and I'll give you the list of things after this that you can make sure you have in that one place. But ensure your finances are up to date. Make sure your equity is clean, and then just bring everything together in the single place.
Yes. I guess I don't know if you'll talk about this, but Equity Clinic, that's an opportunity for people on the call, for founders to deep dive into all of this with someone on your team, right?
Yeah. So it's like dental surgery. I hate going to the dentist. I absolutely hate it. It's like the thing that I put off for the longest period of time. And often founders do that with their equity. They just, I just don't want to look at it. It's a mess. I'll just sweep it under the carpet and hopefully nothing will grow underneath there that I can't manage. So they technically don't, get into it. Whereas Raise has got an equity clinic that then takes people through generating their corporate health score, gives them areas of concern, and then the next thing that they can do to mitigate that risk underneath that. So it gives them practical steps on the next thing to do in order to clean up that equity score.
Awesome.
So guys, if you're looking for the things that you need to have lined up in order to go into a raise or a round, here are 10 things. And Caleb, sense check this with me to see, like, if you were sitting on the other side of the table as an investor and I arrived with these 10 things, how investable would I be based on these 10 things? So let's just jet through them quickly. Okay. The pitch deck, right? I always say packaging matters. I don't know. I'm one of those people where, like, the details, if there's like stuff, if it just doesn't look good, I'm like, it's the first thing. Packaging matters. Like, you know, put together something that shows that you care enough to look at the details. So your pitch deck. The second thing is your organizational structure. Have your registration certificates and your shareholding up to date and available. All of your certificates in place, including your shareholding certificates. An up-to-date cap table. Okay, latest transactions, everything on board. Audited financial statements with tax clearance certificates available. So that you've had at least a third party look over your financial statements, say, yes, there's a thumbs up here, and that you've got that tax clearance certificate from your tax registration board that you are with. Scenario models for conservative baseline and moonshot outcome. So have your scenarios out. Execution capability. So show me that you can execute the team and the internal infrastructure, if it's technology or whatever that you have built into your business product and team, in order to service the execution capability of your business. Make sure you indicate that. A pre-money valuation, we've spoken about it. Contracts. If you've got contracts with major suppliers or major customers, I want to see that your house is in order. So if you've got those major things that demonstrate, first of all, traction in the market, people trust you enough to put their money with you or to work with you, show us the contracts that you have with major customers or major suppliers. Then your spending plan, your CapEx and your OpEx spending plan. Okay, what are you going to do with this money? How are you going to spend it on capital expenses? How are you going to spend it on operating expenses? And give us at least, it's difficult to predict past a year's worth of growth, but I would say a year's worth of CapEx and OpEx spend would be sufficient thereafter. And then what are the metrics going to be used to measure success? So are you going after signups? And you shouldn't be generating signups, please, as a single metric of success. Okay, but average account value as an example, net profit margin as another example. Have metrics for growth, actual real growth in the business. Revenue is not profit. I have to say that again. Revenue is not profit. And businesses exist to make profit. So show us your profit. If you're an impact-driven business, you can show us the impact, but then show us the profit as well. Those would be hard boundaries for me if I was sitting there. But Caleb, you need to sense check this.
Okay, so if I would say that, like, some of the best companies I've invested in have maybe 8 of these 10. More typically, you'll have like 6 out of 10, and I'll have to ask for things like, the financial statements, or if we ask for that, or like, the contracts. Like, that's one that we generally ask for. Even cap tables. Actually, no, cap tables usually in that. But I would say, 6 out of 10, 6, 7 out of 10 is like good. 8 out of 10 is really good. If you had 10 out of 10 of these, I think you're just ready to go, and that just shows that you're very serious. It would make it like.
Am I missing anything in this list? Can you think of anything that I'm missing in this list?
Yeah, I'm trying to think. Not that I can think of. I think it's a bit hard because startups are like specific, right? So you're building in a specific domain, so different things matter. Like we're looking at a social media app, and so we need like deep metrics on data, user behavior, which probably you might not have in this. Maybe that comes under metrics actually. But we need like, pretty detailed data in Excel for that. Or fintech, where we need we're looking at credit history, and so we want to know how they analyze that and then modeling.
Absolutely. Okay. So it's a sector specific registrations, clearances, and metrics.
That's right. Yeah. Because every startup's different. You have something you're very good at. And so how do we measure how good you are at that? We need to see that data.
Yeah. I love what Adelino's put in the comments there. 11. Don't look desperate.
So good. It's honestly
Yes.
true though. Like I think if you
Yes.
have, it's just like, yeah. So I mean, I'm sitting on both sides as like an investor and a founder, and maybe we can actually
Mm,
talk about this in the final part, which is
mm,
how to raise, because we did ours the end of 2021.
yeah.
So and that was like 2 million, or maybe 1.5 US or 1.2 US or something.
Yeah.
And we had a pretty good strategy. Like we closed that round in 2 weeks. It was a good
Mm,
market, but we still had a pretty good
yeah.
strategy to that. So a lot of it came
Yeah.
around some of the things we talked about. So
Yeah.
um, should we hit that section, Lisa?
I think we should.
Okay,
Okay. So tips for building momentum.
love this.
So the first one that I wanted to put in here is that you leverage your marketing assets, have your marketing assets functioning well. So many people, when they go into this, don't think that you're going to have it. Someone's going to check what's going on. Someone's going to go onto your website. Someone's going to check. They're gonna check if you're doing what you say you're doing. So have your marketing assets functioning well. I don't know how many times like I've landed on a website and it's out of date or there's an error code on it, and it's so simple. It's such a simple thing. But you can lose the investment there and then. So have your marketing assets functioning well, and that often will help with a close. Leverage your social proof. So social proof can come in the form of all kinds of things. PR. It can come in the form of testimonials. A close can happen by saying, here's a customer that you can phone right now and speak to them about their experience with this. And that person-to-person interaction can often just be the game changer within that. So leverage social proof. And then so many people say, the stand-up, particularly if you haven't done a pitch before and if you haven't pitched for investment before, you take the feedback that's given to you as like this personal offense. I loved watching the reruns of our Shark Tank when we pitched, because people stood up there and they were so offended, like pearl clutching, offended by the feedback that was given to them by potential investors. But there are absolute gems in what they give in terms of feedback. So your first pitch is never going to be your first pitch. Learn from it as much as you possibly can, and then implement the feedback and the valuable suggestions through that. Because typically, if your investor is not going to get involved at a pre-seed round, if there's a seed or a state or a series A round that they might potentially be interested in, and they've seen that you've implemented what you were given as feedback in your first pitch to them, that's gold. That's gold for closing rounds later on. But having your house in order, that'll you'll close. You just said to me, if 10 out of 10 is there, there's your chances are very, very high of having all of those things lined up. And then implementing these things. You've got levers outside of the pitch den that you're in, which is your marketing assets and your social proof that you can pull, and then even looking at this as a long-term relationship building exercise. That if you take and implement that feedback, especially if it's valuable to the growth of the business, that investors more than likely later on going, hang on a second, this person actually is serious.
Yeah, that's awesome. Cool. Can I chime in on this?
Yeah, please.
Awesome. So I have a few takes, which I'll throw in there, and I'll just recount a bit of our experience raising. But as I'm doing that, I just wanted to note we have officially the session wraps up now, but I'm guessing you've got more time, Lisa. So
I do. You can have a little bit more time, but it's only because it's you, Caleb, right? Only because it's you.
I'm honored. Team, so yeah, I guess everyone listening, just type your questions in. If you've got questions for Lisa and I, type them in and we'll try to answer them. And as you're doing that, let me just run you through some of the things that I think also help. So I love the third point, which is listening to feedback and implementing suggestions. There's been a few times where we have we haven't invested in a company, but they've kept us in the updates. They implemented the feedback and they're like, yeah, we know this is a problem. We're going to fix it. And we've come and they haven't raised yet, but we're like, if they do, we really want to invest. So it's definitely like a really valid point. I think just showing like how you think about that feedback is important. Yeah, some of the other things is like, yeah, so I think of it as like it's all about momentum, I think. When you're raising, it's like how do you just get and keep momentum? So thinking about that momentum, it's like how do you when you start, you actually know who you're going to talk to, you have your list ready, your ham, you meet all of them. And I think one of the things that really helps is like when people know that there's pressure and people know that you're kind of like you're in those conversations, it really helps. So one thing we did, which is a bit like, whatever, we would always we did two things that worked well. The first was like we would let other investors know we were talking to other investors and kind of name them. And I think that's a small thing, but it actually helps a lot because they're like, okay, they're serious.
The legitimacy. Yeah.
Conversations. Yeah, it's social proof, right? Like in some ways it is social proof. As soon as you get an investor, you should make noise about that. So if we got an investor, we'd be like, hey, this fund is just committed. And we do that. If you do that a couple times, you'd be like, oh shit, they're about to close this round. So you build the hype around that. The other is something I've seen work really well. We didn't do this, but I would definitely do this if I was raising again, is weekly updates. So having like everyone who's around you, just giving them weekly updates on what's happening. If they're in a circle, giving them asks like, hey, I want to meet an investor at this company, or I want a connection to this person. Can you help? And if you have 10 people on that, a startup we couldn't invest in because they were too far ahead. They CC'd us in their updates, and their progress is incredible. Like they met almost every fund they wanted to because they had like 15 people who were at different funds who wanted to connect them to those funds.
It's a brilliant way of you heat map it. You do a heat map. And you go, all right, this person, so you'd go, right, I want 10 potential investors. Great. Now you take your closest core team, your network, and you go, right, who do you know that knows somebody that knows somebody? And you heat map how close they are to those investors. And then you start getting those introductions. So it's a great way of building that hype and building that momentum, because people talk, right? Traffic breeds traffic.
Yeah. And you just want to keep the heat on, like until you're there. So I think that hype thing is like super, super important. I think those are kind of my tips on how to build momentum as well. And with that, we should segue to questions.
Yeah, there was a question up here about, and Collins, you've got, how do I calculate the pre-money valuation around that? So calculating pre-money valuation, it does have a couple of layers underneath that. Unfortunately, we don't have the time to get into it. But one of my team's going to drop in a link to a form. So if you want to pop in some details there, and then we can actually just send you some material that you can read on how startup valuations can work. There's actually a couple of different methodologies of doing it there, and we use about 5 of those. So as soon as that link is in the chat, get in touch with us, and we'll help you understand a bit more about valuations and how to do them. So thanks, Colin, for that. And I think there was another one, by King. Yeah, it definitely was off topic that they want to register a patent in South Africa. You'd have to go through a patent lawyer. There are different types of patents, design patents, intellectual property patents. There's different ways of doing it. So if you would probably use a patent lawyer to decide what type of patent is necessary for the business. So yeah, cool.
Does raise have a min and max? What's it?
I don't
Adelina, do you want to explain that a bit more?
Yeah. Okay. Cool. Maybe you can give us a bit more insight into that. Anthony, to answer your question as to whether the link is going to be up afterwards, absolutely. It's going to be on our YouTube channel. I see that you joined through LinkedIn. It is available on LinkedIn afterwards as well, but it's also available on our YouTube channel as well. So thanks, Godson. I think we answered your question already as well.
Yeah. I think we've covered. I'm surprised. Does no one else have questions for us?
We were amazing. We were so good.
Maybe we covered everything.
We covered everything, exactly, or not. We're just drinking our own
Kool-Aid. People are going to raise full rounds now.
Yes, exactly. All that stuff that you've been talking about in your newsletter, all those things that you've been saying, right? We're going to be blowing those metrics out the water.
Yeah, totally.
Amazing.
It's
Okay, well
really,
then should we wrap it up?
I think we should. Yeah.
Okay.
Yeah. Oh, we got one. We got two questions. Maybe we can. So does raise
Okay.
as a minimax? Still not sure what you mean there, Adelino.
Yeah.
Um,
Still not sure what you're saying there. But then
what's the highest amount?
Orpheus says, what's the highest amount you think a pre-sheet could or shouldn't get? That's really difficult to answer because it really does, it's very based on your business, right? Is don't shoot for more than what you need. That's my only advice, is don't shoot for more than what you need. And then you should have a very detailed understanding of what you need and how you're going to spend it.
Yeah. Nice.
Yeah.
Solid.
Cool.
I think Adelino was asking whether there's a minimum or maximum to raise, like on the platform. Is there?
Oh, no, there isn't.
Okay.
No, there isn't. No, there isn't a minimum or maximum.
Awesome.
But yeah.
Great.
So
you
I think that,
so much,
thank you.
everyone.
Yeah, you'll see there in the chat, there is a little form that's put there from the team. Guys, get in touch with us if you want help on your scenarios, if you want help on your valuations, if you want help on your cap table, if you need support on, just making sure that you financial models are ready for fundraising. Get in touch. The services in-house and the people in-house are all bound by this massive transformational purpose, raising Africa one startup at a time. So they're really there as the basis to form support in order for African founders to raise capital sustainably, and to understand the flexibility, autonomy, and and liquidity issues that you're dealing with.
Yeah. Lisa, such a pleasure to have you and to do this with you. Just a treasure trove of information, insights, and great quotables. We need to do this again. And I think everyone
Hell
valued
yes.
it.
Hell yes.
Awesome.
Thank you, everyone.
We'll wrap up
Appreciate
there.
all your attendance today. Yes, and get in touch, raise.africa, if you want to get in touch with us,
Awesome.
or get in touch with us on the form that the team has put in the chat.
Great. Thanks, guys.
Thank you, everybody. Thank you, Caleb. We'll catch you next time.
See ya.
Ciao.